Hello and welcome to this edition of Money, Money, Money. I'm Sumaira Abdi. Today we're discussing an important topic, net worth versus cash flow, which is more important for you. So let me first ask you, how many times have you caught yourself checking your net worth? Or even talking about your net worth, discussing it with your friends or family? But how many of us have checked how good our cash flow is? Will money be available to us when we need it? So today, let's address exactly this. What is net worth? What is cash flow? And which is more important for you as an investor? Joining in to talk about it is Kirtan Shah, founder and CEO of Credence Wealth Management. Hi, Kirtan. Thanks very much for joining in. So my first question to you is exactly this. What is net worth? What is cash flow? And, what is the difference?
Sumaira, thank you so much for having me on the show. Sumaira, when we say net worth, we are typically talking about what is going to be left with you after you've paid all of your debts, right? So theoretically, if I have to put this, I would say net worth is nothing but your assets minus liability. Now, what do I mean when I say assets here? Assets can be any and everything from all your real estate investments, the cash that you have in the bank, the fixed deposits that you've done, all your equity investments, everything put together will form the asset side of our discussion. And liability can be all the loans that you typically have from, let's say, a personal loan to a housing loan. So today, if I have to calculate my net worth, I would say that if all my investments put together that I just highlighted is 100 rupees and all my liabilities that I have to pay together is, let's say, 40 rupees, then from the assets, if I pay off the liability, which is 40 rupees, the remaining 60 is largely my net worth, right? Now, there are a lot of problems, or I would say theory may be very different from a practical standpoint of how you may look at net worth. Let me highlight a couple of things as to why do I make that statement. So while you look at net worth, there are a couple of questions that you might want to ask yourself. First is, do the primary house that I stay in should be included in the net worth? Now, you might say yes, because it is an asset, but then the other way of looking at it is, would you be able to sell it whenever you require, or would you rather liquidate it to pay off a debt somewhere? Or probably, let's say if you run a private limited company and you've been able to build an equity in that company over a period of time, how do you value that in calculating your net worth? Or probably as simple as that, while you're trying to calculate net worth, would you consider all your investments on a pre-tax or a post-tax basis, right? So net worth is slightly subjective, may not be very liquid. So you might look at your net worth and say my net worth is 60 rupees for the example that I gave you, but that 60 might not be immediately available to you as and when you want. And like we discussed, there are a lot of ifs and buts as to how do you arrive at that 60. What is that cash flow is very plain, simple, straightforward, where you are saying that every month, every quarter, or every year, I will receive an X amount of cash flow from all the investments that I've done. Right now, various investors would want to kind of emphasize on various methodology. I mean, there may be some investors who would want to focus slightly more on building their net worth, and then there might be investors who would want to focus or look at cash flows. But I think that is largely individualistic. But in my opinion, net worth is slightly more subjective. Cash flow is apparent. You know the kind of money that you will receive in terms of cash flow for a specified period of time.
Okay, understood. But Kirtan, who are the kind of investors who need to give more importance to cash flow over net worth?
So while we talk about cash flow, Sumaira, I think these are largely investors who are slightly more conservative in nature, who are probably planning for financial freedom very quickly, or probably are very close to retirement or looking at retirement, or plain simple investor who might not be looking at financial freedom or wanting to get retired quickly, but just don't want to take a lot of risk. I think these are the kind of investors who largely want to focus on creating a fixed income or a fixed cash flow for themselves. Whereas if you look at somebody who's more aggressive, right, who has a very steady cash flow income coming in every month, does not want to retire pretty soon, is very confident that if the investment does not pay the cash flow, there is an actual income which is coming in periodically, which will take care of the cash flow. They are slightly more aggressive. They are slightly more looking at creating wealth over a period of time, are the kind of investors who largely look at net worth.
Okay. So naturally, the kind of investing you do would also differ on this, right? So what kind of investing is suitable for which kind of individual?
So Sumera, look, largely if we talk about four assets here, right? We talk about equities, we talk about fixed income, we talk about gold, and we talk about, let's say, real estate. Now, if we understand characteristics of each of these assets that we are talking about, we probably might be able to figure out pretty easily of who would want to go, or rather a net worth based individual would want to go for what kind of assets, and cash flow would want to go for what kind of assets. So if you look at, let's say, fixed income, right? Or let's say, look at real estate. Fixed income and real estate, largely, in my opinion, is something that probably a cash flow kind of investor would want to go for, is because you would typically be able to lease out your real estate property to generate rents. Fixed income typically pays you a cash flow periodically, right? But while you talk about equity, you might have to then further boil down and try and figure out what style of equity investing are you talking about. What I mean by this is, let's say, typically somebody who's a cash flow based investor would largely look at doing value investing style of investing in equity. So if I have to broadly break this down, Sumera, I think while you talk about cash flow kind of investors, you would typically see that they focus more on real estate, they focus more on fixed income. They would want to do a little bit of equity, but that equity style of investing is largely going to be value investing. Whereas somebody who's largely more into wealth creation, net worth building kind of investor, that investor would not want to do a lot of real estate, is because you would note that the rental yield may not really appeal because it is too small for an aggressive investor, or probably fixed income may not be a larger part of the portfolio. You will see lower exposure to gold as well in this kind of a investor. And largely, this investing will happen in equity, more so on the growth or momentum style of investing on the equity side, Sumera.
Okay, can you explain that difference as well between value and growth?
Sure. So Sumera, largely while you do equity investing, we are talking about three styles, right? First is, you say, value investing. Value investing is the most traditional way of investing in equity, where you are saying that you will try and invest in sectors or stocks which are fairly valued or which are undervalued. They are not expensive versus their historical price to earnings ratios or the price to book ratios. So let's say today, if I talk about, just as an example, may not fit in what we are trying to say, but let's say IT. Now IT has fallen 30% from the top, right? Some investors might find value in investing in IT at this point in time versus some other sector which have not fallen 30% from the top, right? So value investing is largely trying to buy those sectors or those stocks which probably, if you compare with the other sectors or the historical data points, you might feel that they are slightly more cheaply available in terms of valuation context. But if you talk about growth investing is a style of investing in where you would want to invest in sectors or you want to invest in stocks which might look expensive at this point in time, which means they might have a higher PE, higher PB, or a higher EV by EBITDA. But these companies, you are pretty confident that they'll be able to continue the staggering growth that they've shown on profits or sales over a period of time. So what typically happens is, while you are expecting that these companies will continue to grow at a very faster pace, you are willing to pay a slightly higher valuation at this point in time, because you know that when the sales and other areas around the business will grow at a faster pace, the same valuation will look slightly cheaper in the future. So growth investing is largely buying stocks which may look expensive right now, but because you are expecting them to grow at a very faster pace, you're okay to pay that. Value investing is versus traditional and historical valuation data points. You probably find this stock or sector slightly cheaply available at this price. And momentum, which we've not spoken about, Sumaira, but momentum largely is a style of investing where you want to invest in stocks which are moving higher. So if the stock is generating positive returns or is moving higher, you would want to invest in those stocks, and you would want to sell stocks which are falling. So these are largely the three types of styles of investing in equity. So momentum and growth is more net worth or aggressive investor type of investing, whereas value is more cash flow kind of investing.
Okay, got it. Kirtan, we're going to take a very quick break over here, but we have more questions to ask on the other side, so do stay tuned in. We'll be right back.